This is week 17. That's not 17. This is week 17 of investing every week in the stock market. I started this series to document my journey in the stock market and in the hope some people might get motivated to start investing or stay consistent with their investing journey. If you're interested, do not forget to subscribe. Every subscriber matters and helps get this video to the right people. We're going to be trying something different this week. My laptop is in fact acting up, so I'm going to be using my phone to invest. Probably cut that out. This week we have around $128 to invest, plus some money in my other accounts through dividends I received last month, for a grand total of around $160. My first buy, as always, is going to be in the S&P 500, an index that tracks the 500 biggest companies in the United States of America. Historically, this index has returned 10% on average for the last 40 years. Recently, it has seen a nice downturn. And I say nice because I do believe in the long term the S&P 500 is going to have a positive return. It gives me and other investors like myself a good opportunity to buy in now. The last few years have been incredible. Last 2 years in particular, returns of 20+% for the last 2 years. Absolutely magnificent. And I like this ETF, USSL in particular, since it is 25% leverage. What does leverage mean? The S&P 500 goes up an average of 10% every year. If you add leverage onto that, you can magnify your returns. This ETF, since it is 25% leverage, is going to go up 12.5%. However, the opposite is also true though, since there is no free lunch. If the index goes down 10%, this ETF is going to go down 12.5% plus leverage costs. So you can see the pros and cons here, but if you, like myself, believe in the long-term potential of the S&P 500, slight leverage might be a nice benefit of holding on to the index. So I'm going to queue an order for 1 share of USSL, queue the order, and done. My next buy is going to be in the NASDAQ 100. This is an index that tracks the 100 biggest companies in the United States of America, similar to the S&P 500. However, this is extremely concentrated in the tech sector. Nvidia, Apple, Microsoft, Google, Tesla, you name it. Companies that have delivered the most value in the last few years have been tech companies. This ETF is in fact up 26% in the last year. The last few years have been incredible in terms of return. I'm not saying that this return is sustainable in the future. However, I do think tech companies are going to generate value. Any forward-looking industry, if you look at AI, if you look at autonomous vehicles, if you look at automation in general, it's all technology. So if the value is going to come, it's going to come from the technological sector. And much like USSL, this ETF, QQQL, is also 25% leverage. So I'm not only getting the nice return, I'm adding leverage onto that. I do understand the risks. It could go down in the next few years, but I do believe in the long-term potential of the US tech sector. So I'm going to queue an order for 1 share of QQQL, queue the order, and done. My next buy is going to be the Canadian market through this ETF called VDY. This is an ETF that tracks the TSX 60 and, to be particular, the FTSE high yield dividend paying stocks. It has done decent in the past year and the past 2 years, but I hold this ETF primarily for the dividend. It has a nice yield at around 4.2 to 4.5%, depending on the price of the ETF. It holds all major Canadian industries, for example, banking, financials, insurance, healthcare, telecoms, all of the oligopolies that we love and adore in Canada. That dividend yield is a nice incentive to keep on holding solid Canadian companies. The Canadian economy has not done as well compared to the US economy. However, I do think in the future, given Canada's humongous potential in natural resources in particular, they're going to be able to harvest that and give some return of that to the shareholders. And for that reason, I'm going to go ahead and buy 1 share of VDY, queue the order, and done. My next buy is going to be in a leverage all equity ETF through this ETF HEQL. This is also 25% leverage, but what does all equity mean? It basically means it holds not just Canadian and US companies, it also holds international companies. Something you'll notice with my portfolio is that I love America and I love Canada, I love North America as a provider of growth for the future, but I do want to partake in the international economy as well, just in case developing economies and other developed economies, not including Canada and the US, end up providing returns for the next 10, 20, or 30 years. HEQL allows me to do that. 60% of the holdings are still in North America, but that 35%-ish international exposure is enough for me. And that leverage element, that 25% leverage, is going to recover some of those lost returns for not going 100% US. Diversification is good, international markets might do well, and I think 25% leverage is perfectly okay. So I'm going to go ahead and buy 1 share of HEQL, queue the order, and done. My last buy for this week is going to be in HYLD. This is a Hamilton ETFs product that is a covered call ETF tracking the US market. The US market we've explored before, but what does covered call mean? Covered call ETFs are pretty controversial online. People want to really fight each other and pick one side or the other. They sacrifice some long-term potential growth to give you that return now, because they write call options at or very near to the stock price. I'll leave a link in the description if you're interested in learning more about covered call ETFs, but I invest a small percentage of my portfolio in them because they keep me motivated to invest. The S&P 500 has a yield of around 1%. HYLD, which tracks the S&P 500 pretty much, has a yield of around 12%. Seeing that dividend income go up every single month in my account is a huge motivating factor for me to continue to invest. Also, this ETF does not write call options on 100% of the portfolio, which basically means that it's not going to sacrifice all long-term potential growth. As you noticed in the last year, it is up, and that 12% yield is just an added bonus to hold on to the stock. My goal with covered call ETFs is to keep my exposure below 15%. This ensures that most of my portfolio is still growth focused and I'm still able to keep motivated, seeing that monthly amount of dividend income go up again and again. Those monthly dividends do feel nice, I'm not gonna lie. So I'm gonna go ahead and buy 1 share of HYLD, to the order, and done. I am officially out of money, which means that is it for this week's video. Not much to invest, only $100 something, but that is the point of this series, is to tell you what a realistic journey in the stock market looks like. This is the power of investing every week. No matter if you have $50 every week or $5,000, you need to be investing, you need to be partaking in the stock market. And hopefully my journey is going to motivate some of you to start investing also. As always, smash the like button and the subscribe button if you enjoyed this video. Every like and subscriber matters because it helps get this video to the right people also interested in money, finance, and how to invest more. I'll see you next week.